All right. Okay. Welcome, everyone. Thank you so much for coming
Goodness.
today. Did we see the recording notification? All right. So we're recording. Welcome to the inaugural edition of Learning with Leia, where we're going to be exploring finance and insurance. Today's topic will focus on fighting financial ignorance. Okay. So despite living in one of the wealthiest nations, financial literacy remains a challenge. Shockingly, 95% of Americans will end up financially insecure, largely due to financial miseducation. So I've learned that most people struggle getting their arms around their finances. This stems from the fact that there's no formal mechanism for teaching how money really works in the United States. All but the upper class are forced to figure it out as we go along. And if we do manage to get ahead, the general stigma around discussing our finances, especially amongst our family and friends, prevents us from sharing the secret sauce. So the formula for success does not get passed through. Now, with the perpetuation of this cycle of secrecy around how to win the money game, how can we be expected to ever really break through? Okay, unfortunately, most of us don't. In financial circles, there's a saying, shirt sleeves to shirt sleeves in 3 generations. It's often used to describe the challenges of passing down wealth and describes the idea that wealth typically doesn't last beyond 3 generations. So if we're going to do better, if we're going to break the shirt sleeve cycle, we have to learn to win the money game. And then we need to teach the formula to our children. So I think it's time to start sharing what we know and working together for the greater good. So I'm stepping out here and sharing a little bit of what I've learned in order to support those of you who want to do a little bit better. All right. Now, most of you already know me, okay? But let me catch everybody up. I'm an executive director at Experior Financial Group and the agency owner at Harmony Financial, which is located here in historic Newcastle, Delaware. To give you a little background, Experior was founded in Ontario, Canada in 2014. And we have over 75 agents across Canada and the US. We just crossed over that last week. At Experior, we're building financial foundations for families to empower them today and leave a legacy for tomorrow. We teach financial literacy based on principles that are proven in order, to facilitate personal financial freedom and responsibility for individuals and families. My agency, Harmony Financial, is home to over 50 agents serving families from coast to coast, and we are growing every single day. The goal for today, guys, is to overview strategies that work, to open a dialogue and help stimulate thought about how you're going to secure your financial future. So, small disclaimer here. I'm a licensed life and health agent. I am not a CPA or a tax planner. So, we are going to be discussing some tax-related topics today, but please don't interpret any of this as tax advice. Okay. All right. So, as we prepare for life's journey, from a financial standpoint, you need to think, does your portfolio have everything that you need? So, solid financial planning requires balance and understanding of several dynamic factors. It's crucial to incorporate tools that protect and grow your wealth, especially for long-term security. So, as we proceed through this webinar today, I want you to keep a couple things in the back of your mind. Ask yourself a couple questions. Are you 100% sure that you're going to have a great retirement, or do you have some doubt? Do you actually have a financial plan, or are you just hoping that things are going to sort of work themselves out? So keep this in mind as we move through today. Let's get going. So, financial portfolios can be divided into 3 basic buckets. A diversified portfolio includes short-term savings, long-term investments, and income protection tools. So when you look at the different tools that are in these buckets, we all recognize most of them. All right? You know, checking, savings, CDs, annuities, 401ks. Okay? Combining elements from each bucket in a deliberate and balanced way is what ensures both growth and stability, especially during life's uncertainties. So today we're going to explore where each of these fits into a wealth management strategy. Let's start by shedding light onto one of the most misunderstood and underutilized tools in the portfolio, and that would be insurance. So what is the definition of insurance? Insurance is simply the transfer of risk from an individual to a larger group. Some types of insurance are required by law, like auto insurance, homeowners insurance, renter's insurance. And some are optional: health insurance, life insurance, fire insurance, flood insurance. Okay, all are important because they help mitigate your financial risk from triggering events. So participation in the group affords you protections when things go badly. Just think about all of our friends and family out there in California right now who are suffering through those terrible fires. Those who do not have insurance are going to be hurting in a big way. All right. So look, my mom always told me, and she's on here, she said it's better to have and not need than to need and not have. This is definitely the case with insurances. So when it comes to your various insurances, don't be cheap. When you need it, you need it. All right. Now, let's take a closer look, particularly at life insurance, because it's going to be a critical part of the discussion all the way through the rest of this conversation today. All right. So most people don't understand life insurance. The most common misconception is that it only pays when you die. This is just not true. Okay. Life insurance can be a versatile financial instrument and a powerful source of leverage while you're living and when you pass on. So the trick is just to find the right fit for you. Now, there are two primary types of insurance, okay, term and permanent. So term insurance is temporary. It's temporary coverage. The premiums go 100% towards your death benefit. So I want you to think of it like renting a luxury apartment, okay? You get to keep it as long as it serves your purpose. And when it no longer serves your purpose, you walk away, everybody's free and clear, no harm, no foul. All right? Permanent insurance, on the other hand, combines a death benefit and a cash value. And I want you to think of it like buying a house. So you're in it for the long run, and you put it in the equity, you put it in the work. Let's go a little deeper. All right? So term insurance is going to include group plans, employer provided, maybe a credit union, something like that. And then there's individual plans, which are going to be privately owned for a particular period of time. All right. Then permanent insurance includes options like final expense, whole life, and index universal life for purposes of our discussion today. Okay. Each are going to offer various levels of flexibility and benefits. So let's break it down a little bit. Group life insurance definitely has its purpose, okay? It's got super low costs. I mean, sometimes it's free, right? There's guaranteed insurability. So you come to your employer, you fulfill your probation period, and then you're eligible and you're covered, okay? It's basically a flavor of term, where the term is the time of your active employment, okay? So it's good to have, but there are some significant drawbacks, okay? First of all, you have absolutely no control over the policy. So your employer can discontinue, increase, decrease the coverage at any point. It lacks benefits while you're alive, and it has very low payout probabilities. You literally have to work until the day that you die for it to pay out. All right. Now, don't get me wrong. Okay. I encourage everyone to take advantage of group insurance whenever it is available to you, but never, ever, ever rely on it as the sole source of your coverage. Okay. It can be your gravy, but it can't be your bread and butter. It can be your icing, but do not let it be your cake. All right. Now, other term insurance, so now we're going to move to everything that's not group insurance, is absolutely the most popular choice due to the lowest cost and the potential for living benefits. So when you see the ads on the television, you can get $1 million worth of coverage for $20. Every ad you see on television is usually for term insurance because that is the lowest cost per thousand. Okay. It's going to give you the best bang for your buck. Now, all individual policies moving forward, this is a conversation here, the rates are going to be based on a combination of age, health, and lifestyle. Okay, so you do have to qualify medically to get term insurance. So the price is great, but the coverage is temporary. The premiums are going to rise after the original the initial rate lock term. Okay. And it lacks cash accumulation. You may have an option to renew up to a certain point, but eventually it's going to expire altogether. So depending on how long the people in your family live, you may or may not have insurance at the end of your life. It's not uncommon for premiums to literally double at the end of a 20 or a 30-year term. So maybe about 1% of term policies pay out. So that means that 99% of term policy holders are either outliving their term or they drop the coverage, because when they come out of the initial rate lock period, it takes a huge jump, it catches up to their age, and the policy rate just keeps going up. And at some point you cry uncle and you just walk away. All right. So like the group insurance, there's definitely a place for term. It is highly appealing in stages of life where money is kind of tight and the loss of income could result in a waterfall of unmanageable financial strain for the surviving family. Okay, so think about protecting the mortgage. You got a young family, you got kids, you got cars, you got houses. All these expensive things are happening in your life. If the primary breadwinner ceases to exist, then what's left for the family? How do they sustain their way of life? Okay, so term has its place. Just understand what you're getting and remember that you get what you pay for. So this falls in that category of hoping for the best and planning for the worst. But that's what insurance is about, right? Okay. Now, let's move on to permanent coverage, okay? That's going to include final expense, whole life, and indexed universal life. So in each of these, part of the premium is going to go towards a death benefit, and part of the premium is going to go towards cash accumulation, okay? Final expense is exactly what it sounds like. It's designed to last as long as you do and help with those end-of-life expenses. The coverage is going to range generally from $4,000 or $5,000, maybe up to $50,000. All right. Whole life policies are going to give you a higher face value of coverage. They can go all the way up to the top. They're also going to provide coverage for your entire life, and they're going to build that cash value. Both have the options of at least some living benefits. Okay. They're going to build cash value at a fixed, very conservative rate of cash growth. But here's the kicker. For final expense and whole life, traditional whole life, the payout can never exceed the contractual face value of the policy. So that means that depending on how old you were and how you were rated during underwriting when you came through, you could get upside down in a whole life policy. So if you have a $10,000 policy that you didn't buy until you were 75 years old and you had some medical situations going on, you could actually get to the point where you've paid more than $10,000 into the policy. And when you pass away, it's still paying 10. That's it. Okay. And then there's the IUL. Let's look at the IUL. So IUL stands for Indexed Universal Life. I want you to think about the IUL like a marriage between a term and a whole. So if a term policy and a whole policy came together and they had a baby, that's going to be an IUL. All right. So the term, a lot of times people and my agents will ask me, well, why are we doing term? Why are we doing an IUL? You got to understand they're very similar under the bottom. So think about a car. All right. So you got two cars that are riding on the same chassis. All right. We got the wheels, we got the struts, we got the frame of the car. Okay. To say that the underlying, so in the policy, the underlying underwriting for a term policy and an IUL policy are exactly the same. So if you can qualify for a term, you can qualify for an IUL. The difference is in the execution. The devil's in the details, right? So both of these are going to be great cars, okay? But the term is the Prius, and the IUL is the Porsche. So if the requirements to get the policy are exactly the same at the bottom, and you can afford the Porsche, and the Porsche fills your needs, then we want to go for the Porsche, right? So some of the advantages of the IUL, you can see them here. We've got tax-free growth and compounding, liquidity, protection from your creditors, flexible premiums, a safeguard against market downturns. The IUL is kind of like a Swiss Army knife, all right? So what's the downside? You know, what's the catch? There's always a catch, right? The catch is you got to pass through a rigorous underwriting to get into it, just like you would for a term. And the policy is also very, very complex. most agents don't know how to structure an IUL policy, and most clients don't understand it. Okay, so it's important that these policies are properly structured based on what it is that I understand your needs to be, and not based on my potential commission. So I'm going to give you, for the client, the premium is going to be the same, but you got to make sure that you trust your agent and that they're putting your interests first when they structure these policies. Because if they load them up with an unnecessary amount of insurance, it just drives their commission up and then your cash just builds up slower. All right. So with all these wonderful Swiss Army knife features, the other downside is that most people think that it's too good to be true, so they won't even take a look at it. So I'm here to tell you that it's not too good to be true. And who says that? The IRS says it's not too good to be true. So IRS code 7702 allows certain life insurance policies to accumulate tax-free cash value. This provides a significant advantage, enabling tax-free loans against the policy when they're needed. Now, to be clear, an IUL is a powerful tool that we can use in retirement and for cash flow purposes, but it is not an investment. We have to keep it we have to stay within the IRS code so that it stays classified as an insurance policy and doesn't get flipped over into an investment vehicle. If we fund it wrong or structure it improperly, you can lose all the tax advantages if it flips over to a modified endowment contract. Okay, enough about life insurance. Let's move on. But you needed to know that because life insurance is going to be in everything we talk about moving forward. So, in my experience, success leaves clues, right? So, it's prudent to learn from the financially successful. So, if you want to be financially successful, learn from the best. Now, we all know who Warren Buffett is, okay? So, we're going to explore the principles that he uses to grow his empire. So, in a nutshell, Mr. Buffett says, protect your capital and prioritize liquidity. Understand the power of compound interest and avoid excessive taxation. Plan for inflation and unexpected critical illnesses, which are the leading cause of financial distress. So what we're going to do moving forward is I'm going to dig into each one of these, and then I'm going to line everything up for you and show you the big picture. All right? Let's start with principle number 1. Make money, but never lose money. Principle number 2. Don't forget principle number 1. Okay? This is Buffett's most famous rule. It emphasizes the importance of being conservative and careful with your investments. Okay? We've got to avoid loss because recovering from those losses is very, very difficult. All right? So as you guys can see here, on the left side, all of the tools that were in those financial portfolios, I'm lining them up down the left side of this chart. And as we move down each principle, I'm going to compare them. Green is good, red is bad. Okay? So let's talk about this one more second. So wealth management is in 3 phases. Most people think about the accumulation phase. That's when we're making as much money as we can, and we're trying to build that up because we're trying to prepare ourselves for the distribution phase when it's time to retire and we get to reap the rewards of all of our hard work. But what most people forget is that there's a phase in the middle. It's called protection. The protection phase should be anywhere from 10 to 15 years prior to when you're ready to start drawing money out and taking and moving into retirement. Okay? So as you're going to learn as we move through here today, the protection phase is the spot where it's really, really important to make sure we limit our losses because we don't have time to make the money, to make it back. Okay? So how do we limit the loss? So let's examine how money can grow. Okay? Now look, there's 3 ways that our money can grow. It can grow in a fixed model. We can have variable growth, and we can have index growth. So a good example of fixed growth is like a CD or a bond. Okay? The rate never changes. It's a small percentage tied to the principal. So you've got a conservative, predictable, and a safe investment. That's fixed growth. Okay. Then there's going to be variable growth. The stock market is the best example of variable growth. Or maybe, those are doing the Bitcoin thing right now. Ooh, up, down, right? Okay. So the stock market is going to subject us to gains and losses. It rides like a roller coaster. It's got the potential for exhilarating highs and devastating lows. Okay. So let's take a second here. I want to give you an example of what happens in the stock market. This is going to be easy math. Let's assume you've got a portfolio that's worth $100,000. Okay. You wake up on Monday morning and you find out that the market has dropped 50%. Oh my God. All right. So you have a bourbon and you go to bed and you hope it's going to get better. All right. You wake up Tuesday morning, lo and behold, the market has bounced back. It recovered 50%. Hallelujah. So my question to you is, what is the value of your portfolio on Tuesday after the market dropped 50% and then it bounced back 50%? Is your portfolio still worth $100,000? The answer is no. Your portfolio is worth $75,000 because you dropped 50% down to $50,000 and then you gained 50%, which is $25,000, to get you back to $75,000. So this is a good way to show how difficult it is to recover from these losses. All right. And finally, we're going to look at indexed growth. So indexing utilizes, I'm going to slow down here. Indexing uses what's called a point-to-point crediting system. It's going to be based on the performance of an underlying index. Okay. So when we're looking at indexing, we're watching what's happening in the market. So maybe it's a Standard & Poor's index. Maybe it's the Barclays index. Maybe it's the Moody, right? So the money is not actually riding the roller coaster of the variable growth path, but we're paying attention to what's happening there. So I like to think of indexing as being market adjacent. Okay. So we take a point-to-point crediting mechanism. So what's going to happen here is that let me get a little pointer going for me here. All right. So if we've got point A here, okay, so today is point A. It's January 18, 2025. We're on a 1 year point-to-point. We're going to look and see what the value of the index is on January 18th of 2026, no matter what happens along the way. Okay, so let's just say the market, that particular index, let's call it the S&P 500, that index has a gain when we look at January 18th of 2025 and we compare it to January 18th of 2026. So we're going to credit that growth to our account. So now January 2026 becomes our new point A, and we wait another year to see if the market is up or down on that day of the year. So if there's growth, our new basis is everything that we had the first time plus what we got, and then we'll add that on. But if the index has dropped, if it started at 10 and it finished at 9, we don't incur the loss, we just hold pat. Okay, so indexing is going to move up in this stepwise fashion this way, where it protects you from the losses, but you get to take advantage of the gains. So we like to say that zero is our hero when we're looking at indexing. And the IUL is the best example of indexed growth in action. This is why I went back to show it to you in the beginning, because I'm going to show you how it works right now. Okay, so we're going to compare performance in a variable growth model versus an indexed growth scenario using mutual funds, 401k, IRA. So the two blue columns there are the variable growth model. Okay. And then we're going to compare that to an index universal life in the same time period. Okay. This IUL, we're going to use a 1 year point-to-point crediting strategy. It's got a 15% cap and a 0.75% floor. The cap, sometimes this is a potential downside of an IUL. The cap is the maximum amount of growth that can be credited to that IUL account during that particular crediting period. Okay? And in this case, this policy actually has a floor that is greater than 0. So let's take a look at what happened. We're looking from 1997 through the end of 2016. That's 20 years. Most of us have been around a long. We know what happened back then, right? So let's look at 97, 98, 99. The market is balling. Everything is growing. Everybody gets money flying all over the place. We started with $100,000, and we can see the money growing. Okay? So for the IUL, though, we've got a 15% cap. So no matter if the market goes up 30%, we can only give credit for the 15%. So we can see the growth in our $100,000 in the IUL is not as fast as it was in the variable market in that environment. But then the next 3 years, we had this mixed bag of market loss. Okay? So you can see that some of the gains that we got up here are starting to get clawed back. Now in the IUL, we had that 0.75% floor. So it's not growing a bunch, but we're not losing any money. So we're protected from the loss. Over the next few years, we got a mixed bag of growth going on here. Some of the years are growing more than 15%. So the IUL is constrained to the 15% growth. And some of the years, it's a little less. So the IUL gets the same as the variable. And then 2008 hits. Who remembers how much money they lost in 2008? I don't even want to talk about it. Okay. The market dropped almost 40% that year. Okay, so you can see that almost half of the growth that's been accumulated up until that point is lost almost instantaneously there. But the IUL with that 0.75% floor is protected from the loss. So we're holding pat. All right. So you're getting the idea of what's happening here. You're going to watch it as it comes all the way down and it works through. I want you to take a second and think about our family members or your friends who were really queued up for retirement right around 2008. They were ready to retire. They were within 4 or 5 years of their retirement. And then in one fall swoop, almost half of their life's work was gone overnight. Were they able to retire? Some yes, some no. Was their retirement what they thought it was going to be? If their money was all tied up in the market, the answer is no. Okay, so when we come down here at the end of 20 years, we can see their $100,000 investment in the variable market. It rolled the roller coaster. We got the ulcers. It looking like it's about $300,000 down here. But wait, you have to pay taxes on those gains. So you got to give the government back $90,000 and you're going to net about $200,000. So you started with 100, you finished with about 2. Conversely, the IUL was protected from those losses. So down here, we're looking at about a little over $500,000. All right. And guess what? I told you can pull money out of an IUL in the form of a tax-free loan, and therefore none of that money is taxable. So you get to keep all of it. This is the power of protecting yourself from market loss. And that's why it's the number one principle with Warren Buffett. Okay. But look, there's better news than this. We have IULs now that don't have any caps. So can you imagine if we were able to credit to the IUL here in those years where the market did better than 15%, the difference here in the bottom line will be even more substantial. This is the power of indexing. All right. Let's move on. We're going to look at principle number 3, management versus no management fees. Okay, so this is going to be in alignment with the advice of financial educators like John Bogle, the founder of Vanguard, who advocated always for low-cost index investing. So high management fees can erode your investment returns over time. So you need to opt for low-cost passive investment options like index funds, EFTs, to maximize your gains. Okay, a lot of our traditional investment vehicles that are falling in bucket number 2, kind of here in the middle of this chart, they carry some pretty stiff management and service fees and loads. So when you're making your choices in these investment vehicles, always look for the ones that have the least amount of fees and the least amount of loads. All right, let's move on. Inflation is 3%. It's kind of like a statement. And the reason why inflation stays around 3% is because the Fed manipulates the interest rates to stimulate spending and control inflation. Okay, so it's a basic financial principle. Every economist and financial advisor is all on board with this. Okay, so we know that inflation reduces the purchasing power of our money over time. So if we're going to be smart, our investments have to yield a return that's higher than the inflation rate to preserve and grow our wealth. All right, you got to choose things that are greater than 3%. So if you keep a lot of money sitting around in your checking account, you might as well have it in the mattress or in the coffee can in the backyard, because you're losing money to inflation every day. Okay? So my checking account, last time I looked at it, was like 0.005%. That's awful. All right? So we got to be careful where we have our money and make sure we're keeping up with inflation. All right? Just for points of reference for you, there are two different types of inflation. There's core inflation. That's a measure that includes volatile prices like food and energy. It reflects long-term trending. And then there's headline inflation. That tracks all consumer spending, and it reflects the day-to-day cost of living, short-term and volatile. So in November of 2024, it's about the election, right? The headline inflation was 2.7%, and core inflation was 3.3%. All right? Can you imagine you're receiving your Social Security, they give you your COLA, it's 2.5. So every year when your cost of living allowance on your Social Security is less than 3%, you're getting further and further in the hole every single time. All right, principle number 5, avoid double taxation. Okay, this is a core principle in all tax-efficient investment strategies. So double taxation occurs when income is taxed at the corporate level and then it's taxed again at the individual level. So tax-efficient accounts like Roth IRAs, 401ks, 403bs, TSPs. This is why people like these kind of vehicles, right? They help us avoid or reduce the double taxation. So we need to actively seek opportunities to avoid this. Anytime you're paying taxes on financial gains that have been manifested from investments where you've already been taxed, that's the textbook definition of double taxation. Okay? So think about the statement you get when you do your taxes on your dividends from the previous year, or your earned interest statement from the previous year, or you sold a stock that had a gain. You're paying taxes on all of that. That is double taxation. All right? Now, life insurance has been a secret weapon for the elite for generations, preventing the IRS from diluting their gains through taxes and facilitating the passage of tax-free wealth from generation to generation. Let's keep going. Let's look at flexibility and liquidity. Okay, so this is just good general advice. All financial educators will talk about these two principles. All right, so liquidity is defined. It refers to the ease of which you can access the funds when you need them. Okay, generally, there's an inverse relationship between liquidity and the amount of interest that you can earn. So let's look at your checking account. It's super liquid. You can put your money in as much as you want. But we already said it's only earning like 0.005% interest. So the easier you can get to it, the less interest they're gonna pay. All right. Flexibility, on the other hand, is about ensuring that you have financial strategies in place that are going to adapt to changing life circumstances. You need to choose investment vehicles that are going to give you the opportunity to not only get to your money when you need it, but use it for whatever you need to use it for. If you lock it in a box where it can only be used for one or two particular situations, what if that situation doesn't manifest itself? What happens to your money? All right. So the IUL is the workhorse in this category. Again, we can access the accumulated cash through tax-free loans, and those loans can be used for anything. All right, let's talk about compound interest. We're going to stick here for a little while. All right, so Albert Einstein is the man on compound interest. Okay, compound interest allows investments to grow exponentially over time because the interest is being earned on both the principal and the interest. So just like in that indexing example that I gave you, you've got your principal, it earns some money. That becomes your new base. Now that base earns the next level of interest, and the next, and the next. Okay, so you're going to get an exponential growth there. Okay, the earlier you start, you get to maximize this effect. So let's go back to Mr. Buffett again. He akins compound interest. He says it's like a snowball rolling down a hill. The trick is to have a very long hill, which means you start very young, or live to be really, really old. Okay? He was born in 1930. He's getting up there. All right? So let's explore what compounding kind of looks like. So like I said, Albert Einstein is the compounding guy, okay? He says compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Okay? We're trying to learn how to play the money game. All right? So are we going to play the game, or are we going to get gamed? Compound interest is that sword we got to ride. So let's look how it works. So let's take $100,000, 10% interest, easy math, right? In the first couple of years, the simple interest and the compound interest, they don't really look that different. You know, they're doing all right. You get up here around year 10, I can start to see a little bit. But when you get to years 20, 30, 40, this is when you can really see the power of compounding and the time value of money. Okay? We need a long hill. We need to let it roll. All right? One of my favorite policies to work with families on is what we call the $1 million baby. We use an IUL to fund a policy on a child as young as 2 weeks old. We can put a very small amount of premium on that because the cost of insurance on a 2-week-old is very small. We structure the policy in a way that the money compounds and it rolls down that hill. And by the time that child is ready to retire, they have at least $1 million in accumulated tax-free cash that they can use for whatever they need. And by the way, they have access to that money along the way if they need to pay for life as life starts lifing. I love $1 Million Baby. All right. Let's look a little closer at how compound interest fits into the larger economic puzzle. Okay? Let's move away from insurance for a minute. Some little miniature economics lesson. All right? Look, y'all can read that part. I'll tell you this part. The economy is fueled by transactions. Okay? One person's spending, whether it's through cash or credit, is another person's income. Credit creates debt, which is an asset to the lender and a liability to the borrower. And it incurs a cost. That's the interest. This also initiates a cycle of lending and borrowing. Okay? So the lending and borrowing cycle is essential to fuel the United States economy because this is not a cash-based economy. If we were living over in one of those Eastern Bloc countries in Europe where you got to have cash for everything and you save for a gazillion years before you get to buy your house or your car, it'd be a different situation. But here, the lending and borrowing cycle fuels our economy. In order to win the money game, you have to play the game. You're going to need to take on some debt. The way you repay this debt is going to determine your credit worthiness. Your credit worthiness is reflected in your credit score. The more you demonstrate that you can be trusted, the higher your credit score goes, and the more credit will be extended to you. So understanding how credit and debt works is absolutely essential. So look, all debt is not bad because we got to play in the game. So let's take an example. You decide to take out a loan and you go out and you buy a big old flat screen TV. Okay? Probably not the smartest use of your money. That's not good debt. All right. On the other hand, if you go and you take out a loan to buy a work truck to help you run your business, or if you're a farmer, you go out and you buy a tractor, that's good debt because it's allowing you to generate more income and move up the chain. So what we want to do is strive to leverage good debt, but don't carry the debt. All right? So you want to participate in the economy, take the loan, and pay it back. We've got to break the negative debt cycle that's fueled by compound interest when you're on the wrong end of the compound interest. Okay? So a strong credit score is going to open the door for more opportunity and favorable loan rates. And a poor credit score locks you into the predatory cycle of paying high interest rates, and it digs that bottomless pit of perpetual debt. So, and then sometimes you get to the point when your credit is bad that you're relegated to only using cash. But again, our society is not really based on a cash society. So if that's what you're limited to, then all of a sudden you're kind of locked in a very, very small box, expensive box. All right. Let's move on to the next. Social Security. We all know Social Security. That's our government financial program, right? So understanding how Social Security benefits work, including when is the optimal time to claim your money, is essential for retirement planning. So look, it was never designed to be your only option in retirement. It was only designed to replace maybe 40% of your pre-retirement earnings. And how that's determined is based on how long you worked, how much you made, when you planned, all of these different things. So that if we know that our retirement is really not going to be able to be funded by Social Security, and thinking about, my son and my daughter and my nieces and my nephews, I don't even know if there's going to be Social Security by the time they get out there. They're paying and they may get nothing. Okay. So who do you want to be responsible for making sure that the supplemental piece is going to be correct? It's got to be you. You got to be the goose that's handling the golden egg. So we got a plan, right? So just understand how Social Security works. Let's keep going. We're almost done. We're looking at principle number 9. Okay, critical and chronic illnesses. These are the number one cause of poverty and bankruptcy. So this is super important in insurance and healthcare policy contexts. Okay, medical emergencies and chronic illnesses can lead to financial ruin without the right insurance. All right, and so when your finances get all messed up, your credit score gets all messed up, you can't get good loans. We just talked about that on the other slide, right? Now I did see that, I think it was maybe last week, Biden has signed all this stuff on the way out. He just signed something that says that in March of this year, the credit bureaus are no longer going to be able to count unpaid medical debt against your credit score. That's going to be a help for a lot of people, because once your credit score kind of gets in the toilet, then you've got this chicken and egg situation going. It's hard to get out of it. Okay, so we got to plan for these things. Critical illness insurance, long-term care planning help protect against this kind of a risk. But again, when you look at life insurance, the living benefits that are built into a life insurance policy or fixed index annuity are very easily accessible. And the triggers can be terminal illness, chronic illness, critical illness, Alzheimer's, or Lewy body, dementia. Or if you just cannot do 2 of the 6 activities of daily living, walking, bathing, eating, dressing, getting in and out of a bed, transferring. All right. In a fixed index annuity or a life insurance policy, you can get to that money if you need to. And some of them have riders where your cash value is actually multiplied in a triggering event. All right. Last but not least, Warren Buffett talks about nurse, estate, and probate court system. So every estate planner, every legal advisor is going to tell you that you got to make sure that you got your house in order, right? Proper estate planning. So we're talking about wills, trusts, medical directives. These things are all crucial to avoiding probate court. So if you haven't lined everything up in a legal way, you can't just say it. You got to have it in writing, right? And you have any assets when your time comes, the state's going to decide how those assets are distributed. If your family's not in agreement with that, they could spend a year in probate court trying to work it out. Okay, so we want to make sure we have a smooth transfer of our assets and that our healthcare decisions are going to be handled in the best way that we can. And then the other piece that I want to talk about here is crediting, protection from creditors. All right. So I'm going to use an example. O.J. Simpson. Now, look, I don't care if you think he did it or not. All right. All right. O.J. Simpson. They went after him. They wiped him out, cleaned him out down to his Heisman trophies. All right. But guess what they couldn't get at? The money that he had in his insurance policies and his annuity policies. They are protected from his creditors. So the time when he was sitting over there in jail and cooling his jets in the jail, his money was growing, his life insurance and his annuity policies. That's how these people can get sued and all this stuff. And you wonder how come they're not over there on Skid Row. They got life insurance, people. All right. So let's line it all up and see how they compare. As you can see, when you line it all up, life insurance is the clear winner with fixed index annuities right behind it. So that's to say that if you're not including these elements in your portfolio, then you're missing a large part of the wealth building equation. The good news is that life insurance and FIAs are what we specialize in at Harmony Financial. I write those all day, every day. All right. So we've got the flexibility to help you find solutions to your financial challenges. We have so many partners. Okay. So no matter where you are, no matter if you're just getting started and you're just looking, you're like, look, I just need to make sure I don't leave debt behind for my family, or whether you're at that place where you're trying to build that wealth so that your family can use it now and for generations to come, I can definitely help you with that. But let's bring this thing all the way around. Let's bring it full circle, because your financial journey is about more than just insurance and annuities, right? So look, are you struggling with debt? Do you need to prop up your credit score? Do you need to button up your paperwork, wills, trusts, medical directives? Do you own a business? Are you ready to stop overpaying on your business taxes? Do you know 93% of small businesses overpay on their taxes? Okay. Do you need help with an estate plan? Are you balling and now you're ready to take advantage of a high net worth wealth management team? Through Experior, I have access to nearly 90 partners in the United States that can help with all of those things. Okay? So, look. Ben says it. If you think education is expensive, try ignorance. Okay? Being poor in the United States is expensive. It's very expensive. All right? The world is full of predators who take advantage of those who lack understanding. So I firmly believe that the more we know, the better we do. So I got some recommended reading for you here. All right? I've talked about a lot of things, but never take my word or anybody else's word for anything. You need to check on for yourself. Okay? So let's always be learning and go ahead and check these out. All right? Now, it is said that you can't go back and change the beginning, but you can start where you are and change the ending. So imagine if someone had introduced these concepts to you when you were younger. If somebody had done it for me, I can only speculate at how different my path would have been. Okay? So now that you do understand the time value money and compounding, you know that the younger you are, the more leverage you have. But no matter where you are in your journey, it's not too late to improve your. So look, now you know, right? So thanks again for giving me the opportunity to share some things with you. Okay. I hope that you consider this as time that was well spent. If you learned anything new today, then I did my job. Okay. If you're curious about how to do something to better your situation for yourself or for someone that you know, then reach out to me so we can chat. You can go to my link tree here and connect and follow me on social media. All right. So thank you guys so much. I'm going to go ahead and stop the recording here.